Welcome to the Explainer. Today we're diving into a really high-stakes scenario. What happens to your bond portfolio, your so-called safe money, when a major war breaks out? We're going to unpack how this kind of conflict can create an inflation storm that just silently demolishes your returns. And more importantly, we'll look at the strategic moves you could make to protect your wealth.
And this quote, this right here, is the brutal truth we're talking about in a hypothetical 2026. You look at a 5% yield, and it feels safe, right? It feels like you're making good money. But when inflation is absolutely roaring behind the scenes, that feeling, well, it's a dangerous illusion. Let's get into exactly what this means for your money.
All right, here's how we're going to break this down. First, we're going to bust a huge myth about bonds in wartime. Then, we'll do the hard math and see the real damage inflation is doing. After that, I'll show you a key market signal that the pros watch like a hawk. And finally, we'll get to the good stuff, a powerful strategic solution.
Okay, Section 1. Let's talk about a core belief a lot of investors have, maybe you have it too, that when a war starts, government bonds are the safest place on earth for your money. It's a classic playbook. But in this scenario, it's being turned completely on its head.
You know, historically, this has been a totally sound reflex. When the world gets scary and uncertain, investors run for the safety of government debt. It makes sense. But the problem with this hypothetical 2026 conflict is that it completely flips the script. The energy shocks it creates generate so much inflation that this old sanctuary actually becomes a trap. It's a ticking time bomb for your wealth.
Now let's meet the real villain of our story, inflation. A conflict in a place like the Persian Gulf, which is so critical for energy, doesn't just mean you're paying more at the pump. No, it creates a shockwave that supercharges inflation across the entire economy.
And here's the proof right here. Just look at this chart. The conflict has caused a massive spike in what people expect inflation to be. The one-year outlook jumped a full percentage point, 100 basis points in a single month. It went from 3.8% to 4.8%. That tells you the market is scrambling, repricing everything for an environment where high inflation sticks around for a lot longer.
So what does that 4.8% inflation really do to a nice safe 5% bond yield? Let's say you invest $10,000. After one full year, this number you see on the screen, $20, that is your actual, real-world wealth gain. That's it. Kind of shopping, right? Let's break down how we even get there.
Okay, this slide is where the magic, or the horror, really happens. So you see that $500 in interest hit your account and you feel good. You're making money. But here's the invisible part. Inflation just eroded the buying power of your original 10 grand by $480. So your real take-home gain is just 20 bucks. That is a staggering 93.3% reduction in the wealth you thought you were building. It practically vanished.
And you know what? This trap actually has a name. Psychologists call it the money illusion. It's this mental bias we all have where we focus on the number of dollars, that nice $500 gain, without really processing that the value of those dollars has been crushed. Inflation is secretly eating our lunch, but the illusion makes us feel richer than we are.
Okay, this brings us to a really crucial question. We know what inflation expectations are right now, but that's just for the next year. How can we figure out what the big money professional investors are betting on for the next 5, 10, or even 30 years?
Well, the answer isn't in some news headline. It's actually hidden in plain sight, right inside the bond market itself. There's a powerful metric that cuts through all the noise. It's called the break-even inflation rate. Now, it sounds a little technical, but the idea is actually super simple. You take the yield on a regular government bond, and you subtract the yield on a special inflation-protected bond. The number you're left with, that's the average inflation rate the entire market is betting on over that time. It's the market's collective forecast. It's the hurdle that real inflation has to clear for one type of bond to beat the other.
And this table right here, this shows the opportunity perfectly. Look at the 10-year break-even rate. It's just 2.39%. That means the market is pricing in average inflation of just 2.39% over the next decade. But wait a minute. We just saw that one-year expectations are at 4.8%. That huge gap, that disconnect, suggests the market might be seriously underestimating the risk of long-term inflation.
So here's the bottom line. If you believe that this geopolitical conflict is going to keep inflation higher for longer, and specifically higher than 2.39%, then there is a clear strategic advantage to be had. You're basically making a bet that the market's forecast is wrong.
Which brings us right to the solution. Let's talk about Treasury inflation-protected securities, or as everyone calls them, TIPS. These are bonds that were literally invented to solve the exact problem we've been talking about this whole time.
So what's the difference? Well, a normal bond has a fixed principal. You invest $10,000, you get $10,000 back when it's done. But a TIPS bond, it's different. Its principal value actually goes up with inflation as measured by the Consumer Price Index, or CPI. It's designed from the ground up to protect you.
Let's just walk through a quick example so you can see it in action. You invest 10 grand. Let's say inflation runs at 5% for the year because of that energy shock. Well, the government automatically adjusts your bond's principal value up to $10,500. And get this, your interest payment is now calculated on that new higher amount. So both your original investment and your income from it are protected from inflation. Pretty cool, right?
What this does is create some really clear tactical signals for you. An environment like the one we're describing, where you're getting paid a real yield and the break-even rates are way below what people expect inflation to be, that's a pretty strong signal to consider getting in. And the exit signal? That's when the gap closes. When the break-even rate rises up to match the forecasts, that tells you the opportunity is probably fully priced in by the market.
So let's wrap this all up. There are 3 huge takeaways here. First, understand the danger in those long-term bonds when inflation is high. Second, think about reallocating to assets that are actually built to protect you, like TIPS. And third, and maybe most importantly, always break that money illusion and think in real after-inflation terms. That's the only way to know if you're truly getting ahead.
And that really just leaves us with one final question to think about. In a world where these geopolitical shocks can come out of nowhere and completely rewrite the rules, it's time to take a hard look at your own portfolio and ask yourself, is it built for that nominal illusion, or is it built for real-world returns?